Kevin O'Leary is a very wealthy investor who is thought to be worth over $400 million. We are big fans of the popular television program Shark Tank, where he is well known for his role. You might be surprised to learn that Kevin enjoys making dividend investments. In fact, he was so passionate about strong dividend-paying firms that he started his own ETF. In this video, we'll examine Mr. Wonderful O'Shares Dividend ETF and discuss why he enjoys dividend stocks. Hey, welcome to Stock Market Mate. Today we'll outline the ETF Kevin O'Leary created particularly to invest in dividend-paying businesses. We'll also explain why he favors them above other types of equities. However, before we get into today's video, do leave a like and subscribe to the channel. If you're done with that, then let's get right into it. Kevin O'Leary's philosophy of investing. In the early 1960s, my mother used to invest a third of her income in major captive and paying stocks as well as corporate credit. This portfolio had been around for 50 years when she passed away, and I had the opportunity to view it for the first time as an executive. She had kept it a secret from both of her husbands. It was amazing that you couldn't find evidence of such in dividend-paying stocks and corporate credit over a 50-year period. So as I started my research, I learned an intriguing truth that permanently altered my philosophy of investing. Rather than capital growth, dividends accounted for 71% of market returns during the past 40 years. Therefore, my first rule is that I will never own anything that doesn't even pay a dividend. The absence of a yield cushion makes firms that don't pay dividends particularly volatile when you look at market volatility around those names. What is the worth of a stock that never pays its investors back money? Not sure. But the only way you can profit is if someone else is prepared to purchase that position at a higher price, possibly out of emotion, or for some insight that perhaps the business would one day return funds. As an investor, you realize over many years that free cash flow is the one factor that matters. That's it. Nothing else justifies owning stocks. Here is a rundown of Kevin's main points. When choosing an investment, cash flow is taken into consideration. This makes sense because the only practical way to repay capital to shareholders is through cash flow. The rules that apply when purchasing a stock are the same as those that would apply if you were to acquire a full company. As Warren Buffett likes to remind people, you must earn a profit and receive a return on your investment. If you as a business owner are unable to produce positive cash flow, you will not be able to profit from running the company. The only other option is to attempt to sell the company to someone else for more money, who would also hope to someday see a return or to try to sell it once more. As Kevin has stated, this is all speculation. In the end, if your company has no way to generate cash flow, long-term stockholders will not value it. Kevin bases his argument on the idea that dividends are the only way a shareholder may profit without having to liquidate some of their stock. Hence, he recommends buying dividend-paying stocks. He also cites the figure that dividends, not capital gains, account for 71% of all market returns. On top of that, consistency and diversification are major factors that Kevin considers when making investments. He keeps this in mind when creating his dividend ETFs for this reason. Ousa. On our most recent monthly portfolio update video, we had a number of comments from viewers asking about suitable dividend ETFs. So let's examine Kevin's Ousa US Dividend ETF. My name is Kevin O'Leary, and I'm the chairman of O'Shares ETFs from Shark Tank. I get a lot of questions from individuals about investing in the ETFs I own. Here is how I invest in US large-cap stocks. Ousa, a quality dividend ETF with over 100 large-cap equities. I've received excellent performance and dividend income from it. Just the better quality corporations, not the other 500 biggest, are what I'm after. So I own Ousa. The best thing is that I obtain performance that keeps pace with the S&P 500 while experiencing 30% less downside during stressful situations. I helped build this US large cap ETF, which is also in my portfolio. The majority of market returns are driven by dividends, as Kevin hinted previously in this video. Why is that so? It relates to the idea of compounding interest. The following figure illustrates what Albert Einstein famously said. Compound interest is the most powerful force in the universe. The S&P 500's price return since 1957 is greater than 6,500%. Over 46,000% is the total return when dividends and compounding are taken into account. This indicates that dividends and compounding account for almost 80% of the fictitious total return that an investor would have achieved over this extended period. Profitable dividend-paying businesses have the capital to sustain and increase their dividend payments over time, which makes the situation even better. The dividends per share paid by the S&P 500 corporations have more than doubled between 2010 and 2019, growing at a rate of around 11% annually. Let's look at the companies that are in Ousa now. Some of these names might sound familiar to you if you are a subscriber to our channel: Microsoft, Johnson & Johnson, Home Depot, Procter & Gamble, Merck & Co., Verizon, Pfizer, Apple, Cisco, Honeywell, United Health Group, Amgen, Coca-Cola, Lockheed Martin, PepsiCo, and 3M are among Ousa's top holdings as of December 2020. The ETF is chosen to feature high-quality, publicly traded, dividend-paying firms and currently holds 101 positions overall. It is very diversified, as evidenced by the breakdown by sector. Healthcare accounts for 22% of the total, followed by information technology 21%, consumer staples 16.5%, industrials 14.8%, and so on. The fund's price return since its launch in July 2015 has been 52%. Additionally, based on the dividend return of the portfolio generated that month, it distributes monthly dividends to stockholders that vary in size. Why not ETFs? We reach the crux of why we dislike managing funds and ETFs at this point. Even if the fund loses money or performs no better than you might do on your own, fees still take a portion of your assets each year. Over time, these costs can significantly reduce total returns. Additionally, we simply like more investing control. You have no control over the investments that these funds make. Additionally, we believe that their commitment to providing immediate financial gain for their investors prevents them from adopting a long-term perspective. They ought to have reloaded at a cheaper price per share if anything. Just at the beginning of this year, they had such strong feelings for their businesses. ETFs have a low risk tolerance and are hesitant to accept short-term losses in exchange for long-term gains. They must continue to add value to their clientele, according to the justification. If they take significant short-term losses, the clients will leave, which will cause their money to fall drastically. This is more of a general criticism of ETFs than a direct attack on Ousa. For individuals who want to start dividend investing but don't want to conduct the research and stock selection themselves, we believe Ousa is a good dividend ETF. Even if you are not interested in ETFs, researching dividend funds might still be beneficial. You can check to see what they own, which may serve as a point of comparison and an idea for your own portfolio. O'Leary's Tesla investment. Kevin breaks his rule about not buying stocks that don't pay a dividend even though he says he loves dividends, and a sizable amount of his net worth is invested in Ousa. Here's an example of one that's improving for me and in which I really have investments. Tesla. Why? I can now see the road to profitability after all. I've gained 38% on Tesla. The sole reason I purchased it was because my kid was offered a position there as an intern or apprentice, and I told Trevor, I'm going to buy a bunch of stocks on our behalf because the stocks are 30% today. Now 6 months later, the venture is breaking even. The market has therefore upgraded that stock, which is now up over 30%, and I rest my case, Your Honor, that it is evolving into a legitimate business that generates profits for shareholders. Despite what some people may say, we believe growth companies have a place in your portfolio as well. Since 2016, we have invested in Tesla, and it has been by far our best performing investment. Another ETF owned by Kevin is named OGIG. Amazon, Alibaba, Facebook, Alphabet, Microsoft, Shopify, and other global internet giants are the focus of this article. This fund has increased by 112% this year. Although you don't have to adhere to dividend investing solely, it's a smart complement to your portfolio and can help you create a passive income source. That's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!